It's safe to say a lot has gone on since my last Trading212 update, so here's what happened. My last update was on the 14th of January. Since then, we've had 12 million people vaccinated, including me. Donald Trump has finally left the White House and was impeached, and then he was cleared of all charges. Biden was made El Presidente. GameStop, or GameStonks, as it is now formally known, went bananas. Boris was labelled a wet wipe. Bitcoin hit $50,000, and arguably the most devastating of all is Kanye is getting a divorce. But maybe we will get the old Kanye back. I miss him. Welcome back to the channel. My name is Euan, and in this video we're going to go through my Trading212 portfolio update and why I haven't bought anything this month. But please remember, I'm not a financial advisor, so please do your own research before investing your capital. So we usually start these with how many free shares that I've received from you lovely people, but this month, unfortunately, we have not had many at all. Trading212's free share scheme is no longer working. Due to the GameStop situation, they had absolutely loads of signups, which basically meant that they couldn't keep up with the signups and they were trying to get people signed up rather than allocate the free shares. But hopefully they can catch up with this and you will get your free shares if you are owed them. And in light of that, if you do feel like you want to support the channel, then there are some free trade, stake and CoinBase link referrals in the description, which will give you a free share or free Bitcoin, depending on which one you choose. And will also give a kickback to me. So thank you if you do decide to use it. So my Trading212 portfolio update, I can confirm that you need to like that smash button. And also, we are in the green by 24% and we are just over £16,000 invested. So this is all good and I'm happy. But I do want to talk to you about why I haven't bought anything outside of my usual deposits this month. So the main reason is actually perfectly summed up by this Warren Buffett quote. The stock market is a device for transferring money from the impatient to the patient. So in my opinion, it doesn't really matter if you take time out of studying the markets or investing or just following along, as long as you have automatic monthly contributions. Because if you truly want to build wealth through the stock market, then you just need to let it compound. And that doesn't happen overnight, it happens over many, many years, and that will truly build your wealth. And don't forget that the great Warren Buffett, who is one of the greatest investors of all time, has made 99% of his money after the age of 50. Which is absolutely bananas. While I was doing research for this specific segment, I found this article on CNBC's website, and it summed everything up perfectly that I'm trying to explain here. Good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that cannot be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for long periods of time. And this is when compounding runs wild. Sorry for the lecture, but I think it's something definitely to be considered because I'm seeing a lot of stuff about hype stocks, meme stocks, all of this stuff, but this is a very short-term mindset and could potentially leave you in a sticky situation if the markets were to collapse or something like that. So now onto the biggest losers in my portfolio for the last month. And this is kind of awkward considering what I just said, but my worst performing stock is Supply at Me Capital, which is very speculative, and a penny stock, which I mentioned in a previous Trading212 update. And it's currently down 21%. And it's also not trading, so it's not gone well. I currently own 4,776 shares, which I can't sell at the moment because they're not trading. And the reason they've stopped trading is due to a DTR breach. This is as a result of them changing their audited accounts process, which must have raised some red flags, which meant that they were no longer allowed to trade. And according to Supply at Me Capital, they have now resolved this issue and they are working with the FCA, which is the Financial Conduct Authority, to get this fixed. So they can be relisted, and apparently there is no FCA investigation going on into the company. So I think it will be safe and I think they will be relisted fairly soon. I think there just must have been a mistake in paperwork or something like that. As long as there's nothing shady going on here, I do think that this company has a long-term potential of extreme growth. So I will be holding these 4,000 odd stocks that I've got, holding the door, hold door, holding the door, hold door, hold door, hold door. The other notable losers in this category are Surface Ecology, which is down here, we're down 14%, and Unilever. So they are down 15%. Only a small position, not even one share yet, but not looking too good. And another big mover in the wrong direction is Tesla this month. So they did announce that they will no longer be supplying the Model Y, which is their cheapest car. So that is the reason they've dropped a fair bit. I'm still up in Tesla, 29%. But last month, I was up a considerable amount more, but it happens. Anyway, let's move on to the winners this month. So this month, we have a similar winner to last month, and that is Walt Disney. They're currently up 60% in my portfolio. I pumped a lot of money into Disney back in March when they released their streaming service. And I really liked it. And I was like, this is gonna kick off and it's gonna go crazy. And it has. So considering they've got all their parks closed, they've cut their dividend, I'm up 60%, which I'm super happy about because hopefully their parks will be open fairly soon-ish. And also they're pumping all the dividend money that they would have used into the streaming service. So they're bringing out the Star version of Disney Plus, and they're just pumping all this money into the streaming services, which is building and building and building and slowly catching up with Netflix. And at the weekend, their servers actually crashed due to high demand because everyone wanted to watch WandaVision. So everyone wanted to watch that, and it's really, really good. I've personally watched it and I'm enjoying it so far. And this is just one of the first original pieces of content that's gone on there, apart from Mandalorian and a few other things. But they've really, really kicked off. So the sky's the limit for Disney, and I'm really excited to see what they continue doing with this streaming service. And when comparing Disney with Netflix, Netflix don't have the infrastructure like Disney do with their parks and cruises and stuff like that. And the stock might go bananas when the pandemic is over. And the next one we've got is Apple, which is up 37% at the moment. And we're looking good. We've got 6.5 shares of it. And in the past week or so, we got a dividend from Apple, which let's have a look. Let's go into dividends. So we actually ended up getting 3 payments of dividends from Trading212. So something went wrong with their systems and they ended up paying it 3 times. So unfortunately they took that £1.61 back. So what am I going to do? Apple, as always, is looking fairly solid for me. And in the last couple of weeks, they've been hinting, or rumours have come about, that they might be making an electric car. Which, if this happens, would be crazy. I'm not sure it would compete with the Teslas that have already been produced massively on a massive scale. However, they do have a lot of money, like I do mention before. They do have a lot of capital and a lot of cash on their balance sheet. So Apple could potentially be putting millions and millions of pounds, or billions in fact, into this electric car from Apple. So who knows, if that happens, we might see some crazy rivalries between Apple and Tesla. But personally, Tesla have the first mover advantage-ish, so they should be able to ward off competition like Apple. However, Apple have made pretty good products in the past, and they're not going to cut any corners. So we've got iPhones, we've got Macs, we've got Dr. Dre Beats. We know all of these products are sublime. We'll just see what happens. And as we mentioned earlier, Tesla is actually doing pretty well. It's still up 29%, even with this downfall. So another winner for me. And then we have to move on to the UK stocks. So we're doing pretty well. We've got Legal & General at 34%. It's really good, especially as it's a dividend stock. We love dividend stocks shooting off because then you just get more dividends, don't you? So it's nice. Oh, I use that too often. And speaking of the UK, the FTSE 100 is up 12%, which is really, really good considering everything going on, but obviously the news of potentially unlocking the country is very advantageous and looking good. So next we're talking about Airbnb, and we are up 21%. There was a big hype over Airbnb when it first IPO'd because people were saying it was overpriced, but I didn't think it was. I thought it was a valuable asset to buy because Airbnb managed to make money through this pandemic, considering they are one of the companies that probably are most affected, along with airlines and all the other companies, of course. But Airbnb managed to make profit, they managed to make money, which is a very good sign. If they can go through this and still make money, what really can stop them? I think it's only going to get more and more useful as people can remote work. So Airbnbs will become more of a holiday working / environment. So I think there's potential in Airbnb for the long term. The next stock I'm going to talk about is Wells Fargo. they are surprising me. Back in March, they obviously dipped because of the pandemic, and then they continued to dip. There was some controversy around them and their practices, and they did get into trouble a little bit. I honestly thought back in June, July that we were done for, and Wells Fargo were going to just go down to zero. However, they seem to have pulled it back a little bit. I don't know whether that is to do with Wells Fargo doing some things that I may have missed, or it's just slowly recovering to back where it was pre-pandemic. And of course, we want to talk about the biggest holding that I hold, which is the VUSA, so the Vanguard S&P 500, and it looks like we are up 28%, which is really good considering it has actually dropped around 5% in the last week. And hopefully I can average in and make the most of the dip. So my current investing plan is to invest into these 3 pies that you can see here. We've got the 2x2 Ark Invest Pie, where I put £50, and then I've got the pie Felicia Pie, which is a dividend pie, and I put 50 quid in there every single month. And then we've got the newly named Slow and Steady Wins the Race pie. I'll leave a link to all of these pies down in the description so that you can follow along if you would like. So we'll start off with the 2x2 Ark Invest Pie, which is based off the Ark Invest ETF, and I've done a few videos on there which they'll be at the end or linked in the description. And when I was doing the script for this video, it was up around 9% and it's now down to 2.5%, so I'm not quite sure what's happened there. Tesla's down, Apple's down, Zoom's down, Surface Oncology's down. Maybe that's why. Doesn't really matter. We continue, we move. And then we've got the pie Felicia Pie, which is a dividend pie, and it's up 9.41%, which considering it is a dividend pie, that is really, really good. Because dividend stocks tend to be a bit more stable, they're not going up and down as much as growth stocks tend to do. So it is a pretty good return considering. And in this pie, we've received £2.12 or 212 in dividends, which is coincidental really, isn't it? And then the final pie, which used to be called the Millionaire Pie, but I got told off by Trading212. They sent me an email saying that I was misleading people, saying that it was Millionaire Pie. So I had to change it to Slow and Steady Wins the Race with a turtle emoji. So sorry if I've misled you. I don't mean to. I've always said on this channel that the value projection should be taken with a pinch of salt, pinch of cinnamon, pinch of sugar, whatever you want, because it's based on the last 5 years of the companies that you are invested in. And past performance cannot be an indicator of future performance, so just please be careful when you're looking at it. But even if we don't end up with 5 million after 40 years, I'll still be fairly happy. Even if it's 1 million, I'll still be laughing to the bank. So I'll take it. So overall, my portfolio is just under 16,000 now. Bad day in the markets, maybe there is a crash coming, and we're around 24%, and I'm overall happy with that. I know that there could potentially be a slump in the market coming soon, but this is all speculation. I have no idea. You can't time the market, so just be consistently investing, dollar cost averaging, pound cost averaging, whatever you want to call it. So just do your own research and stick to your plan. Anyway, that's it from me. I hope you've enjoyed this video and you've got a tiny bit of value out of it. If you have, smash the like button, comment down below, subscribe, do all those wonderful things. And I'm not a millionaire, but I'm trying to help you become one. So, peace.